A quiet change is happening in the world economy, and most people are not watching it. You may not notice it when you open your bank app, but you may notice it when fuel becomes more expensive, when imported goods suddenly jump in price, when a small business supplier changes payment terms, or when the currency in your country starts to feel less reliable. For decades, one money has sat at the center of the global system: the US dollar. Oil, shipping, loans, reserves, emergency savings, trade invoices. Again and again, the dollar became the language of global money. But here is the part beyond the spin. The dollar is not collapsing. That is too dramatic. But some countries are no longer comfortable depending on it in the same way. They are building backup routes. They are buying more gold. They are testing new payment rails. They are trading more with each other in local currencies. And they are asking a question that could eventually reach your wallet. What happens if the world still uses the dollar, but trusts it a little less? The hidden money system behind ordinary life. When your country imports fuel, the dollar matters. When a business imports machinery, pays for software, or buys stock from abroad, the dollar matters. When families send money across borders, pay school fees overseas, travel, save in foreign currency, or watch food prices rise after a currency shock, the dollar matters. So when nations change how they handle the dollar, it does not stay in a meeting room. Over time, it can affect prices, borrowing costs, investment flows, business survival, and the value of money in your pocket. That is why this story is bigger than a chart about reserves. It is about how national power moves through everyday payments. It is about how a decision made by governments can later show up as a higher import bill, a more expensive loan, or a harder business month. To understand why this matters, go back to the end of the Second World War. The United States came out with enormous industrial power, deep financial markets, and a currency other countries were willing to trust. Under the Bretton Woods system, many currencies were tied to the dollar, and the dollar was linked to gold. That gold link ended in 1971, but the dollar did not lose its central role. Why? Because the world still needed a currency everyone could use. It needed a safe place to park reserves. It needed a deep market where governments and institutions could buy and sell huge amounts quickly. US Treasury bonds became a kind of storage room for global money. Then came another layer: energy. Many countries bought and sold oil in dollars. Trade expanded. Global companies borrowed in dollars. Banks funded in dollars. Over time, the dollar became less like a normal currency and more like financial infrastructure. The road system beneath global commerce having change. The dollar's share of global foreign exchange reserves was about 72% at its peak in 2001. By late 2025, it was around 57%. That is a real decline. Not a one-month panic, a long structural drift. But this is where the spin usually begins. Some people hear that number and say, the dollar is finished. That is not true. The dollar is still involved in almost 9 out of 10 foreign exchange trades. A very large share of world trade is still priced or financed in dollars. Many governments and companies still borrow in dollars. And the US Treasury market remains the deepest government bond market in the world. So the real story is not death of the dollar. The real story is dependence management. Countries are not leaving the main road. They are building side roads because they have learned that relying on one road can be dangerous. So before asking whether the dollar will lose its crown, ask a better question. Why are so many countries quietly paying for backup plans? Look around the world and you can see the pattern. China and Russia have increased trade outside the dollar. China and Brazil have worked on local currency settlement. Some countries are exploring swap lines, digital settlement systems, and central bank digital currency experiments. The Gulf, India, Southeast Asia, Africa, and Latin America are all asking versions of the same question. How do we trade, borrow, and protect ourselves without being completely exposed to dollar politics? Gold is part of the answer. For central banks, gold is not someone else's liability. It is not a bank deposit that can be frozen. It does not depend on a payment network controlled by another power. That does not make gold perfect. It makes gold politically useful when trust is fragmented. This is not a clean replacement. It is a messy insurance policy. Now, bring it home. Imagine a country whose currency weakens against the dollar. Imported fuel becomes more expensive. Transport costs rise. Food distribution costs rise. A shop owner pays more to restock imported goods. A family sees prices go up, even if their salary has not changed. This is why the global dollar system is not abstract. In many countries, a stronger dollar can feel like imported inflation. In others, dollar shortages can mean businesses struggle to pay suppliers. Travelers need more local money to buy the same dollars. Families sending money across borders watch exchange rates closely. Students paying overseas tuition feel currency moves directly. Even in the United States, dollar supremacy is not free. It helps the US borrow and transact globally, but it also places the US at the center of global financial tension. When the dollar is used as a policy weapon through sanctions or financial restrictions, other nations have a stronger reason to design alternatives. For business owners, this can be even more direct. If you import goods, the dollar can affect your cost base. If you export, currency swings can change your margins. If your supplier invoices in dollars, but your customers pay in local currency, you carry currency risk even if you never wanted to become a currency trader. A small manufacturer in Ghana, a retailer in Brazil, a logistics firm in India, a food importer in Egypt, or a software company in Europe can all face the same basic question. What currency do I earn in? What currency do I pay in? And what currency is my debt linked to? That question can decide whether a price rise is a temporary inconvenience or a business survival problem. The future of the dollar is not just about Wall Street. It is about working capital, supplier contracts, import costs, payment delays, and whether a business can plan ahead. This is also why gold, bonds, and global equities keep entering the conversation. This is not investment advice, but it is a useful signal. When central banks buy gold, they are not trying to get rich quickly. They are diversifying trust. When investors buy government bonds, they are often looking for safety, income, or liquidity. When people spread investments across regions, currencies, and sectors, they are often trying to reduce the risk that one country, one currency, or one policy shock dominates their future. The point is not that everyone should rush into one asset. The point is that currency power shapes the menu of choices. Gold, US bonds, European assets, Asian equities, local currency savings, dollar cash, property, business inventory. Each behaves differently when trust in the global money system shifts. And this is why the story is global. In the United States, the question is whether dollar dominance can survive political conflict, debt pressure, and distrust without losing its core advantage, liquidity. In Europe, the question is whether the euro can become more than a regional giant and become a true strategic alternative in reserves, trade, and capital markets. In Asia, the question is whether China can expand the use of the renminbi while still facing limits from capital controls, trust, and market depth. In Latin America and Africa, the question is more practical. How do countries reduce vulnerability to dollar shortages, debt stress, and import price shocks while still needing access to global capital? Each region has a different problem, but they are all reacting to the same reality. The dollar is still dominant, yet dependence on it feels more political, more expensive, and more fragile than before. So here's the real story beyond the spin. The dollar is not dying. Tomorrow's world will still use it heavily, but countries are preparing for a world where dollar access, dollar trust, and dollar politics matter more than ever. That shift may begin with banks and governments, but it does not end there. It can move through fuel prices, food prices, loan costs, business contracts, savings decisions, and investment behavior. When nations build backup routes around the world's main money road, ordinary people may not see the construction, but sooner or later, they can feel the traffic change. And that is why this story matters. If this helped you see the system behind the headline, subscribe to Lessons Untold, like the video, and share it with someone who should understand how global money touches everyday life. We look beyond the spin, beyond the headlines, and beyond the obvious story. See you in the next one.